Tom Lee just made one of the most controversial calls in the market right now. He says that war is actually helping stocks move higher. In this video, I'm going to show you his CNBC interview where he breaks down why the market keeps rising despite everything happening globally. Then I'll give you my full reaction and explain what he really means and whether this rally can actually continue. After that, we'll dive into 3 ceasefire stocks that billionaires are quietly buying right now. Let's hear what Tom Lee has to say.
They will say the ever bullish Tom Lee was ever bullish, but you were also right. I mean, is there anything that is going to stop stocks right now, Tom? Because they just keep going up.
Hi, Brian. How are you? Well, I think stocks are holding up because the economy's actually doing better in the face of this war. And I know it sounds counterintuitive, but part of it is the defense spending, at $30 billion a month, and it may end up being, $60 billion a month. That's actually quite stimulative to the economy. This $20 rise in oil is only adding about $12 billion a month to the household burden. So on sort of net basis, the war is actually helping earnings right now.
Yeah, and it's hard to admit this because I do know that gasoline prices for a lot of families out there are a major cost, especially with all the other inflation of the last 5 years. But with car mileage per gallon up, if you do the math, you're looking at maybe $50 to $100 per family per month in extra cost right now. Again, it's not insignificant. I want to be mindful of that. But it sounds like you're saying that is not enough to damage the economy and thus damage corporate earnings and the markets.
That's right, Brian. I mean, nobody wants the U.S. to be at war.
No.
And of course, we're caught in a fog of war. I do think one of the things we have to remember, even like going back to World War II, the stock market bottomed in May 1942, 5 months after the U.S. entered the war, but before any U.S. troops were even on the ground, either in the Pacific or in Europe. So the market does have a really good way of sort of discounting outcomes. And I think the reason it's going up is I think we're going to end up with a favorable outcome, which I can't say I know why, but that's what it looks like.
Well, and things could change, and I want to get your take on that because let's pray for peace and hope that things tone down. We did have a power poll. I wanted to hear from our viewers and all of our ex-followers and whatever about how they feel. And we asked a very simple question, Tom. It was what matters most for the markets right now? Is it the Iran war? Is it corporate earnings, which are starting to roll out? Or is it interest rates? People can vote now by clicking on the QR code. How would Tom Lee vote on that?
Well, I would say that of those 3, only one can create tail events on both sides, which is the Iran war. So I think that the most important thing to watch and to really be mindful of is the war.
Okay, because the other ones already known? Earnings for the first quarter won't be that affected because the war began basically at the beginning of March. So we only have 1 of 3 months where you've got some energy disruptions. The second quarter numbers will be slightly different. So with that in mind, how closely are you and your team going to be watching first quarter earnings versus second quarter earnings, which will maybe fully price in much of what we're seeing?
Yeah, Brian, we're going to watch both because, as you know, some groups in the S&P are going to be affected immediately by higher transport costs or availability of commodities. And so we're going to get a pretty good picture of sort of that disruption that is working its way through. And of course, that gives us a hint to the inflation shock that's coming. But all that being said, as you know, the world and the U.S. has been dealing with a series of shocks over the last 5 years. So in some ways, I'm not saying the market's becoming desensitized to it, but it's learning to not go into a full-blown panic because
and you still, we're going to wrap it up, Tom. I think you still have your 7,700 price target on the S&P and some individual names. You got the One Oak, Texas Pacific Land, Quanta. Sounds like you're all in on the energy expansion and growth story.
Yes, and I think it's highlighting an important theme over the last few years, which is that every country wants 3 types of security. They want energy security, they want sovereign security, and they want cybersecurity. So I think all of those are going to be good areas for where spending grows and stocks should do pretty well.
Tom Lee starts off by addressing the obvious question. Stocks have been going up consistently, so what is actually stopping this rally? And his answer is surprisingly simple. Nothing right now. That's a bold statement. And this is where I think you really have to separate your personal feelings about the world from how markets actually function. Markets do not price morality. They price outcomes, liquidity, and earnings. Tom Lee's core argument is that the economy is actually holding up better than expected, even in the face of war. And the key driver behind that is something most people are not thinking about: defense spending. He points out that government spending tied to the conflict could be running at around $30 billion a month and potentially rising to $60 billion. That is not a small number. That is a massive injection of capital into the economy. Now think about what that means. That money flows into companies. It flows into jobs. It flows into manufacturing, logistics, technology, and infrastructure. It creates demand. And demand ultimately supports corporate earnings. So while the headlines are negative, the economic impact, at least in the short term, can actually be stimulative. And this is where his argument gets even more interesting. He compares that massive government spending to the increase in oil prices. Oil has risen significantly, which obviously hurts consumers. But when you break it down, he estimates that the additional burden on households is about $12 billion a month. So on a net basis, you have far more money being injected into the system than being taken out through higher energy costs. And that is a key insight, because markets are not just reacting to one variable. They are weighing the net effect of multiple forces, and right now, according to his framework, the net effect is still positive for earnings. Now personally, I think this is one of those moments where you have to be careful. Yes, the math makes sense in the short term, but I do question how sustainable that is over time, because eventually, higher costs, inflation, and consumer pressure can start to build up in ways that are not immediately visible. But in the near term, his argument is logical. Then the conversation shifts to something that I think is even more important for investors to understand: the market's ability to look forward. Tom Lee brings up a historical example from World War II. The stock market bottomed in May 1942, just months after the United States entered the war, and well before there was any clear resolution. That is a powerful reminder. Markets do not wait for clarity, they move ahead of it. And this is where I think a lot of retail investors get caught off guard. People wait for things to feel safe before investing. But by the time things feel safe, the market has already moved. So when Tom Lee says the market is going up because it expects a favorable outcome, he is not saying he knows what will happen. He is saying the market is pricing in a probability, and that distinction matters. Now, of course, there is still uncertainty, and this is where he highlights the biggest variable in the entire discussion: the war itself. When asked what matters most for markets right now, whether it is the war, earnings, or interest rates, he makes it very clear. The war is the only one that can create extreme outcomes in both directions, and I completely agree with this. Earnings and interest rates tend to move within a range. They are somewhat predictable. But geopolitical events can change overnight. They can escalate quickly or de-escalate unexpectedly. That creates volatility. That creates risk. But it also creates opportunity, because when markets are uncertain, pricing becomes less efficient, and that is often where the biggest moves happen. Now, another important point he makes is about earnings. First quarter earnings are not going to fully reflect the impact of the war because it only started affecting the economy late in the quarter, so what we are seeing now is not the full picture. The second quarter will be more telling, and this is where I think investors need to pay very close attention, because if companies start to show resilience even with higher costs and supply disruptions, that could reinforce the bullish case. But if margins start to get squeezed, that could change the narrative very quickly. So this is not a one-sided story, it is evolving. And that is why Tom Lee and his team are watching both quarters closely. They are looking for early signs of disruption, particularly in sectors that are sensitive to transportation costs and commodity prices. And this ties into another subtle but important point he makes: the market is becoming more resilient. He does not say desensitized, but he does suggest that after dealing with multiple shocks over the past 5 years, the market is learning not to panic as easily. And I think this is very true. If you look back, We have had a pandemic, supply chain disruptions, inflation spikes, rate hikes, geopolitical tensions, and yet the market continues to recover. That does not mean risk is gone. It means the market is adapting, and adaptation is a powerful force. Now, toward the end of the interview, he starts hinting at a broader theme that I think is actually one of the most important takeaways from this entire discussion: energy and security. He mentions that countries are increasingly focused on three types of security. While he does not fully list them in this segment, it is clear where he is going: energy security, national security, and economic security. And this is where I want to add my own perspective. I think this theme is massively underappreciated by most investors. We are moving into a world where countries want control over energy supply, control over critical resources, control over infrastructure, and that shift is going to drive massive investment, not just in traditional energy, but in renewables, nuclear, infrastructure, and technology. So when Tom Lee talks about being bullish on energy-related names, it is not just about short-term price movements. It is about a long-term structural trend. And those are the kinds of trends that can create sustained opportunities in the market. But at the same time, I would caution against blindly following any single narrative. Yes, the market is strong. Yes, there are supportive factors, but risks still exist. Geopolitical tensions can escalate. Inflation can surprise to the upside. Policy decisions can shift. So the key is balance. Understanding the bullish case while staying aware of the downside risks. That is how you navigate a market like this. Because at the end of the day, investing is not about certainty, it is about probabilities. And right now, the market is leaning toward a more positive outcome, even if the path to get there is uncertain. Now, let's dive in and talk about the three ceasefire stocks billionaires are quietly buying now. Let's start with the first company, Palo Alto Networks, ticker symbol PANW. Now, before we even get into numbers, you need to understand why this business matters right now more than ever. Because when geopolitical tensions rise, one of the first things that escalates is cyber warfare. And when tensions begin to ease, that risk does not disappear, it actually becomes more complex. Governments, corporations, and critical infrastructure providers do not suddenly reduce their cybersecurity budgets just because headlines calm down. If anything, they increase them, because the threat landscape becomes more sophisticated. This is where Palo Alto Networks sits in a very powerful position. It is not just a cybersecurity company, it is a platform. The company provides end-to-end security solutions across networks, cloud environments, and endpoints. That means customers can rely on a single ecosystem to manage their entire security stack. And that creates a strong competitive advantage. Because once a company integrates deeply into your infrastructure, switching becomes difficult, expensive, and risky. That is what we call a moat. Now let's connect this to the ceasefire narrative. When markets move from uncertainty to stability, capital starts flowing back into growth sectors. Technology, especially mission-critical technology, becomes a primary beneficiary. Cybersecurity is not optional, it is essential. And Palo Alto Networks is one of the leaders in this space. Now let's talk about growth. The company has been expanding aggressively into cloud security and AI-driven threat detection. This is a key shift, because as businesses move more of their operations to the cloud, the attack surface increases. Traditional security solutions are no longer enough. Palo Alto is positioning itself to secure the modern enterprise. And that is where long-term growth comes from. Now let's look at the financial side. Palo Alto Networks has been delivering strong revenue growth, driven by both new customer acquisition and expansion within existing accounts. One of the most important metrics here is recurring revenue. The company has been transitioning towards subscription-based models, which provide more predictable and stable cash flows. This is critical for valuation, because markets tend to reward companies with high visibility into future earnings. And Palo Alto is building exactly that. Another important factor is margin expansion. As the company scales its platform and integrates more services, it can improve efficiency and increase profitability over time. This is where operating leverage comes into play. Now here is where things get really interesting. During periods of geopolitical tension, cybersecurity stocks often outperform because of increased demand. But during periods of easing tension, they do not necessarily decline. Instead, they continue to grow because the underlying need for security remains. That creates a unique dynamic. Palo Alto Networks benefits in both environments. That is why it fits into the idea of a ceasefire stock. It is not dependent on fear, it is built on necessity. Now let's talk about what billionaires see here. They are not just looking at short-term price movements, they are looking at long-term positioning. Palo Alto Networks sits at the intersection of cybersecurity, cloud computing, and artificial intelligence. These are three of the most important trends in technology. And when you combine that with a strong platform model and recurring revenue, you get a business that can compound over time. But let's keep it real, this is not a cheap stock. The valuation reflects its growth and market position, so the question is not whether it is undervalued in the traditional sense. The question is whether it can continue to grow into its valuation. And based on the current trajectory, there is a strong case to be made. Now personally, I like this type of company in this kind of environment, because it gives you exposure to growth without relying on speculation. It is not a story stock. It is a business with real customers, real revenue, and real demand. That matters, especially when the market is transitioning from uncertainty to stability. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second company, and this one might surprise a lot of people. We're talking about Oracle, ticker symbol ORCL, because when most people think about high-growth tech or AI winners, Oracle is not usually the first name that comes to mind, and that is exactly why this opportunity exists. Oracle is one of the most quietly dominant players in enterprise technology. It has been around for decades, deeply embedded in the operations of some of the largest organizations in the world, and that is its advantage, because while newer companies are trying to win customers, Oracle already has them. Massive enterprises rely on Oracle's database systems to run critical workloads. These are not systems that can be easily replaced. They are deeply integrated into business operations. That creates one of the strongest moats in technology. Now here is where the story evolves. Oracle is no longer just a legacy database company, it is becoming a major player in cloud infrastructure and artificial intelligence. And this shift is happening faster than most people realize. Let's connect this to the ceasefire narrative. When geopolitical tensions begin to ease, markets tend to rotate into companies that have strong fundamentals, but may have been overlooked during periods of uncertainty. Oracle fits that profile perfectly. It is stable, it is profitable, and now it is accelerating in one of the most important areas of tech: cloud computing. Oracle Cloud Infrastructure, also known as OCI, has been growing rapidly, and one of the biggest drivers of that growth is demand for AI workloads. Training and running AI models requires massive computing power. Companies need reliable, high-performance infrastructure to handle that demand. Oracle is positioning itself as a key provider of that infrastructure, and here is where things get really interesting. Unlike some competitors, Oracle is focusing on performance and cost efficiency. This gives it a strong value proposition. Companies want powerful infrastructure, but they also want to manage costs. Oracle is offering both. That combination is attracting customers. Now let's talk about the financial momentum. Oracle has been delivering consistent revenue growth, with cloud services becoming an increasingly large part of the business. This is a critical transition, because cloud revenue is typically recurring, which improves visibility and stability. And as more customers migrate to Oracle's cloud, that recurring revenue base continues to expand. This creates a compounding effect. Another important factor is profitability. Oracle is not a startup burning cash. It generates significant cash flow, which allows it to invest in growth while also returning value to shareholders. That balance is powerful. Now let's talk about why billionaires are paying attention. They are looking for companies that can benefit from the next wave of technology without taking on excessive risk. Oracle offers exposure to AI and cloud computing, but with a foundation of stable existing revenue. That reduces downside risk. At the same time, the upside potential comes from continued growth in cloud adoption and AI demand. This is what I would call a hybrid opportunity. You get both stability and growth. And in a market that is transitioning from uncertainty to opportunity, that combination is extremely attractive. Now I want to give you my personal take here. I think Oracle is one of the most misunderstood companies in the market right now. A lot of investors still see it as a slow-moving legacy business. But the reality is, it is evolving. And sometimes the biggest opportunities come from companies that are quietly transforming while the market is focused elsewhere. That is exactly what is happening here. Now let's also be realistic about the risks. Oracle operates in a highly competitive space. Cloud infrastructure is dominated by major players, and execution is critical. The company needs to continue innovating and scaling its cloud services to maintain momentum. There is also the question of perception. If the market continues to view Oracle as a legacy company, it could take time for the valuation to fully reflect its transformation. But again, that is where opportunity lies. Because when perception changes, valuation often follows. Now think about how this fits with Palo Alto Networks. Palo Alto is securing the digital world. Oracle is powering it. One focuses on protection, the other focuses on infrastructure. Both are essential, and both benefit from the same underlying trend, the expansion of digital systems, data, and AI. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the third company, and this is where the entire ceasefire stock concept really comes full circle. We're talking about Palantir Technologies, ticker symbol PLTR. If Palo Alto Networks protects the digital world and Oracle powers the infrastructure behind it, Palantir is the company that makes sense of it all. Data, decisions, intelligence. That is what Palantir delivers. And in a world shaped by geopolitical tension, defense spending, and rapidly evolving technology, that capability becomes incredibly valuable. Now here is why Palantir matters right now. During times of conflict, governments and defense agencies rely heavily on data analytics to make real-time decisions. They need to process massive amounts of information quickly and accurately. Palantir has built its entire business around solving that problem. Its platforms are used by government agencies for mission-critical operations, from intelligence analysis to battlefield logistics. But here is where the ceasefire angle becomes interesting. When tensions begin to ease, Palantir does not lose relevance. It expands, because the same technology used in defense can be applied to commercial industries. Healthcare, finance, energy, manufacturing. This is where the company has been focusing its growth. Palantir is transitioning from a government-heavy business to a broader commercial platform, and that shift is accelerating. Now let's talk about its competitive advantage. Palantir is not just another software company. It offers highly specialized platforms that integrate deeply into an organization's operations. Once implemented, these systems become critical to decision-making processes. That creates high switching costs. It is not easy to replace Palantir once it is embedded. That is a powerful moat. Now let's connect this to the broader market narrative. As geopolitical tensions stabilize, investors start looking for companies that can benefit from both defense spending and commercial growth. Palantir sits at that intersection. It has strong relationships with government clients, which provide stable revenue. At the same time, its commercial business is growing rapidly, driven by demand for AI-driven analytics. This dual exposure is rare, and it is valuable. Now let's talk about growth. Palantir has been delivering strong revenue expansion, particularly in its commercial segment. This is important, because it shows that the company is not dependent on government contracts alone. It is building a scalable business across multiple industries. Another key driver is artificial intelligence. Palantir has been positioning itself as a leader in applied AI, not just building models, but deploying them in real-world environments where they can generate value. This is a crucial distinction, because many companies talk about AI, few actually deliver it in a way that impacts operations. Palantir does. Now here's where things get really interesting. As companies generate more data, the need to analyze and act on that data increases. This is not a short-term trend, it is a long-term shift, and Palantir is positioned right at the center of it. Now let's talk about why billionaires are paying attention. They are looking for companies that can scale with the growth of data and AI, companies that can become essential infrastructure for decision-making. Palantir fits that description. It is not just a software provider, it is a strategic partner, and that creates long-term value. Now I want to give you my personal take here. Palantir is one of the most polarizing stocks in the market. Some investors see it as a high-growth AI leader, others see it as overhyped, and the truth is probably somewhere in between. But what I find compelling is its positioning. It operates in a space that is becoming more important every year, data-driven decision-making. And as that trend accelerates, companies that can deliver real solutions are likely to benefit. Now let's also be realistic about the risks. Palantir's growth needs to continue, its commercial expansion needs to sustain momentum, and its valuation can be sensitive to changes in market sentiment. This is not a low volatility stock, but again, that is where opportunity comes from. Now let's bring everything together. You have three companies: Palo Alto Networks, securing digital infrastructure; Oracle, powering cloud and AI systems; Palantir, turning data into actionable intelligence. These are not random picks. They represent three critical layers of the modern technology ecosystem: security, infrastructure, intelligence. And when geopolitical tensions begin to ease, capital tends to flow into companies that enable growth, not just companies that react to fear. This is the key idea behind ceasefire stocks. They benefit from stability. They benefit from investment. They benefit from the next phase of the cycle. Now think about how sophisticated investors approach this. They do not just look at headlines, they look at trends, they look at positioning, they look at where the world is going, and right now, the world is moving toward more data, more connectivity, and more reliance on technology. That is not changing. If anything, it is accelerating, and the companies we just discussed are positioned to benefit from that acceleration. Now here is the question you need to ask yourself. Which of these companies has the strongest long-term advantage? Is it the one securing the system? Is it the one powering the system? Or is it the one making the system smarter? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Between Palo Alto Networks, Oracle, and Palantir, which company do you believe has the strongest long-term advantage in this next phase of the market, and which one would you hold for the next 10 years? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.